Imagine this. You wake up early, reach for your phone, and before your mind fully wakes up, a headline appears. Goldman Sachs issues warning about the 2026 market outlook. You were calm yesterday. Nothing dramatic happened overnight. Your investments looked stable. Life felt predictable. But now something feels different. You open the article, then another one, then a YouTube video explaining what the warning really means. Within minutes, analysis turns into speculation. Speculation turns into urgency. Comment sections fill with emotion. Smart money is preparing. Big institutions see something coming. Retail investors will be the last to react. And suddenly, a quiet internal question appears. Should I do something right now? This moment is familiar because it repeats in every market cycle. Not because markets constantly change direction, but because human psychology reacts to uncertainty in predictable ways. Every financial forecast produces two outcomes at the same time: new information and new fear. Information spreads slowly. Fear spreads instantly. And here is the important insight. Most people reacting emotionally are not irresponsible investors. They are thoughtful individuals trying to protect their future. Today, we are not trying to predict markets. We are examining something deeper. Why financial warnings trigger powerful psychological reactions, and why intelligent people repeatedly misinterpret forecasts. Because the real story behind market fear is not economic. It is human. If you enjoy calm, psychology-based explanations about money and human behavior, consider subscribing to PsGuys. This channel helps you understand decisions, not chase panic. Human brains dislike uncertainty more than bad news. Psychologists call this ambiguity aversion. When outcomes are unclear, the brain searches for emotional certainty. Even a negative prediction feels more comfortable than uncertainty because it provides direction. Financial outlook reports are written in probabilities. They describe ranges of possible futures, not single outcomes. But the human brain prefers stories over statistics. A report might say, economic growth is expected to continue, though at a slower pace with elevated risks. But emotionally, many people hear, something bad is coming. Why does this transformation happen? Because modern information systems reward emotional clarity. Nuance does not spread easily. Emotion spreads instantly. Behavioral finance research shows humans possess a negativity bias, meaning negative information captures attention faster and stays longer in memory. Thousands of years ago, noticing danger improved survival. Today, that same mechanism reacts to financial headlines as if they were physical threats. Another powerful bias is recency bias. Over the last decade, markets delivered unusually strong returns in many regions. After enough time, extraordinary outcomes begin to feel normal. So when forecasts predict moderate growth instead of exceptional growth, investors interpret moderation as decline. The discomfort is psychological, not mathematical. Expectations changed faster than reality. Intelligent investors often struggle here because they trust analytical thinking. When anxiety appears, they assume it must be logical. But emotion usually arrives first. Logic often follows later to justify the feeling. This creates what psychologists call post hoc rationalization. People believe they are reacting to data when they are actually reacting to emotion triggered by uncertainty. Fear also spreads socially. When many people discuss risk simultaneously, concern feels validated. The brain interprets shared anxiety as evidence. This is herd psychology operating beneath conscious awareness. And this explains why warnings from large institutions feel especially powerful. Authority amplifies emotion. A forecast from a major bank feels different from the same forecast written anonymously, even if the data is identical. By subscribing, you support psychology education that helps people understand financial behavior instead of reacting emotionally to headlines. Money decisions are rarely just financial. They are emotional reflections of identity. Many people unconsciously link investment success with intelligence, discipline, or personal responsibility. When markets rise, confidence grows. When warnings appear, self-doubt appears alongside them. A cautious forecast can feel like a personal evaluation. This connection often begins in childhood. Children observe how adults talk about money. Some households treat money as security. Others treat it as stress. Others treat it as status. These emotional associations become internal beliefs carried into adulthood. Later, investing becomes more than wealth building. It becomes emotional safety. When uncertainty appears, the brain does not only calculate risk, it asks deeper questions. Am I making the right decisions? Am I falling behind others? Am I being irresponsible? Social comparison intensifies this reaction. We live in a world where financial success is highly visible, but financial mistakes remain hidden. People share gains publicly, losses remain private. So when institutions release cautious outlooks, investors imagine others acting faster or smarter. The fear becomes social exclusion. Humans evolve to survive through belonging. Financial anxiety often reflects fear of being left behind rather than objective danger. Another psychological illusion appears through modern index investing. Many investors believe diversification guarantees safety because they own hundreds of companies. But market concentration means performance often depends heavily on a small group of dominant firms. Psychologically, large numbers create emotional comfort, even when exposure is concentrated. Researchers describe this as the illusion of diversification. When expectations about a few major companies change, investors feel shocked. Not because diversification failed completely, but because expectations were unrealistic. Money decisions, therefore, reflect identity, belonging, and emotional security as much as financial logic. Subscribing to PsGuys is like investing in clearer thinking. The goal is not faster reactions, but deeper understanding of money and human behavior. Fear travels efficiently because it activates survival systems in the brain. Neuroscience research shows negative information activates the amygdala more strongly than neutral information. This increases attention, sharing behavior, and memory retention. A headline predicting stability rarely spreads widely. A headline predicting danger spreads instantly. Financial media operates within this attention system. This does not mean media is dishonest. It means emotional information naturally travels further. This creates a predictable cycle. Forecast released, headlines simplify, emotion spreads, investors react, volatility increases. Ironically, volatility created by fear can then appear to confirm the original fear. This feedback loop strengthens emotional narratives. Social media accelerates this process. Humans subconsciously measure reality through collective reaction. If many people appear worried, the brain assumes danger must exist. But emotional consensus is not the same as objective probability. History repeatedly shows markets experience their strongest recovery days during periods of highest fear. And those moments often occur when investors feel least comfortable staying invested. This creates one of investing's greatest psychological paradoxes. The moments that feel safest to sell are often the moments when selling becomes most costly long-term. If prediction cannot eliminate uncertainty, what actually helps? Psychological structure. Here are practical mindset shifts supported by behavioral finance research. 1. Separate identity from financial outcomes. Your investments are tools, not reflections of personal worth. Detaching identity reduces emotional volatility, even when markets remain volatile. 2. Delay emotionally urgent decisions. Fear creates artificial urgency. When decisions feel emotionally pressured, pause. Time reduces emotional intensity and improves reasoning. 3. Define financial values clearly. People often define strategy during stress instead of calm. Ask, what role does money serve in my life? Security? Freedom? Flexibility? Values stabilize behavior when headlines become loud. 4. Expect emotional discomfort. Successful investing often feels uncomfortable in real time. Discomfort is not evidence something is wrong. It is evidence uncertainty exists. 5. Replace prediction with preparedness. Instead of asking, what will markets do? Ask, what behavior remains rational across many possible futures? Preparedness reduces dependence on forecasts. 6. Build psychological liquidity. Liquidity is not only financial, it is emotional. Having mental flexibility allows investors to tolerate uncertainty without panic. 7. Limit information overload. More information does not always improve decisions. Constant exposure increases emotional noise. Selective attention improves psychological clarity. Goldman Sachs, like every financial institution, produces forecasts based on probabilities, not prophecies. No model can fully anticipate innovation, politics, human behavior, or unexpected global events. Surprises are not failures of forecasting. They are features of reality. The difference between reactive investors and resilient investors is rarely intelligence. It is emotional regulation. When headlines become louder than data, perspective becomes more valuable than prediction. Markets will continue cycling between optimism and fear because human psychology changes slowly. Fear will always arrive faster than understanding. But awareness changes behavior. You cannot control forecasts. You cannot control headlines. But you can control interpretation. And often, the most powerful financial decision is patience practiced during uncertainty. Long-term investing is less about predicting markets and more about managing yourself within them. Because markets test patience far more often than intelligence. If this psychology-first perspective helps you understand money more clearly, subscribe to PsGuys and continue building calm thinking for long-term decisions.